Here are 15 tax strategies to lower your taxes in 2024. Let's dive right in. The first strategy is to maximize the retirement contributions. Before the year ends, if you have the means, you should consider contributing the maximum allowed $23,000 to traditional 401k, Roth 401k, and similar plans. Contributing to a traditional 401k reduces your taxable income. For example, if you're in a 24% marginal tax bracket, a $10,000 contribution can save you $2,400 in taxes now. In addition, it can also save you on state taxes. Roth 401ks, while no tax deductible, offer tax-free withdrawals in retirement. As a rule of thumb, if you're below 22% tax bracket, contribute to a Roth 401k, and if you're above that, contribute to a traditional 401k. The second strategy is the MAGA Backdoor Roth. This strategy allows high-income earners to save even more in a Roth account if permitted by a workplace retirement plan. You contribute to a 401k after-tax account and roll the funds over to a Roth IRA or Roth 401k, shielding against future tax. The total 401k contribution limit is $69,000 in 2024. This includes the $23,000 employee contribution and employer match if you have any. This leaves you with around $35,000 of after-tax contributions that you can make. In many plans, you can also roll this after-tax account into a Roth IRA. As I previously mentioned, your employer's plan needs to allow the after-tax contributions, otherwise you can't contribute. The third strategy is Backdoor Roth. If you have a high income, you can't contribute to a Roth IRA directly. But there is a strategy called the Backdoor Roth. It involves making a non-deductible contribution, which is a contribution without the tax deduction, to a traditional IRA and then converting the entire amount into Roth IRA. Importantly, you need to ensure that you have a $0 traditional IRA, rollover IRA, SAP, simple by December 31st. Otherwise, the conversion will be taxable due to pro rata rule. I discussed this strategy in depth in my other YouTube video, so make sure to check it out. The fourth strategy is optimizing charitable contributions. If you're planning to donate to charity before the end of the year, consider donating appreciated shares from your taxable brokerage account instead of cash. Then buy back those shares with the cash you are going to donate to increase your cost basis. This allows you to pay less taxes later on due to the increased cost basis. For example, say you bought $1,000 worth of shares and they are now worth $5,000. Donating these shares avoids capital gains tax on the $4,000 appreciation. Then you can rebuy those shares, which allows you to reset your cost basis with the $5,000 of cash you would have donated anyways. This lowers your future taxes when you have to sell those shares again. The fifth strategy is tax loss harvesting. If you have stocks that have a net loss, consider selling them to offset your other gains or claim a $3,000 capital loss deduction. This might be challenging as the stock market is an all-time high, but if you have a losing security that you've lost faith in, this could be a great move. Just be sure not to buy back the same or a similar stock within 30 days to avoid the wash sale rule. For example, you sold a stock for $5,000 loss, you could offset a $5,000 gain from another stock. If you don't have any gains in the year, you can take up to a $3,000 deduction against your other income types, and the $2,000 will be carried over in the future. Next strategy is tax gain harvesting. If your taxable income is below $47,000 or $94,000 for married filing jointly in 2024, consider selling appreciated securities at a gain and buying them back. This increases the cost basis of your investment and lowers future tax liability. For example, say you have a $50,000 W-2 job. After the standard deduction, your taxable income is around $36,000. You can sell a stock for a $10,000 gain and pay 0% federal tax rate. Reinvesting the proceeds raises your cost basis, which will lower taxes if you sell again at a later date. Just keep in mind any state taxes and any other credits that you would qualify for, like earned income tax credit. The next strategy is Roth Conversions. If you have no income for the year, you can do a Roth Conversions, where you convert your traditional IRA into a Roth IRA. If your income is below the standard deduction, which is $14,000 for 2024, this could be a great way to avoid future taxes since you convert from a tax-deferred account to a tax-free one. This is ideal for someone who is maybe taking time off from work or maybe going back to school. The next strategy is to maximize health savings account. HSAs provide many tax benefits. For example, you get a tax deduction for your contribution, the investment inside an HSA grows tax-free, and you receive tax-free withdrawals for medical expenses. You can contribute $4,100 for an individual plan or $8,300 for a family plan if you have a high deductible health plan, which is a plan that has minimum deductible of $1,600 or $3,200 for families in 2024. For example, contributing $8,300 as a family in 24% tax bracket saves you around $2,000 in federal taxes. The next strategy is donor advised fund. If you have charitable donations, you may want to consider investing in a donor advised fund, DAF. You can contribute a lump sum all at once and then distribute those funds to various charities over several years. This allows you to take an immediate deduction that you may have only received if itemized deduction was larger than the standard deduction. For example, if you typically donate $1,000 annually, consider doing a $5,000 DAF contribution in 1 year. Then you can spread that $5,000 donation over multiple years, and it will help you increase your itemized deductions. The next strategy is qualified charitable distribution. If you're 70 and a half or older, you can donate up to $105,000 to a charity directly from your IRA using a QCD. The strategy allows you to avoid paying taxes on the distribution, satisfy the required minimum distributions, and lets you take the standard deduction without having to itemize. This is great for retirees who don't itemize deductions but still want the tax-efficient philanthropy. The next strategy is business entity. If you're a business owner, choosing the right business structure could help you save thousands in taxes. An S corporation can save you self-employment taxes. For example, earning $200,000 net as a sole proprietor incurs about $26,000 in self-employment taxes. As an S corporation, you could pay yourself a $100,000 salary and take $100,000 in distributions, thereby reducing the self-employment tax to about $13,000. However, one thing you need to keep in mind is that an S corporation requires additional tax filings, running payroll, and might have some state tax impact. So it's important to analyze your numbers. Section 179 is also a great strategy. If you're a business owner, consider maximizing the benefits of a Section 179, which allows you to immediately deduct the cost of qualifying property and equipment as an expense rather than capitalizing the cost. If you buy a $50,000 truck for your business, Section 179 allows you to deduct the full cost in the purchase year rather than depreciating over several years. This lowers taxable income now and could help you invest in other business needs. The next strategy is expense tracking. Keeping your books and expenses organized can save you a lot of money in your business and ensure that you get a tax deduction for all of your expenses. Start now so you don't get rushed at the end of the year. Many small business owners miss deductions because of the lack of proper tracking. Using tools like QuickBooks or Excel ensures that you don't miss deductions. The next strategy is deferring income. If you're self-employed or do freelance work, you can try to delay billings until late December. This can help ensure that you won't receive payment until the next year. However, this only makes sense if you will be in the same or a lower tax bracket next year. If your bracket will be higher, this doesn't really make sense. The next strategy is gifting. In 2024, you can give away up to $18,000 or $36,000 for a married couple per person without impacting your lifetime estate and gift tax exemption. This won't reduce your taxes now, but will allow you to strategically transfer wealth to your heirs tax-free. If your estate exceeds $13 million exemption, these annual gifts can reduce future estate taxes. Overall, I hope you enjoyed this video. Let me know down in the comments which strategy did you like the most, and make sure to hit that subscribe button.